You know, for decades, economists were staring at a huge puzzle, a real head-scratcher. What happens when a central bank hits the brakes on the economy? Well, you'd think things would slow down, right? But for the longest time, our best economic models were showing the exact opposite. Today, we're diving into a paper that finally cracks this mystery wide open. It's called Monetary Policy Matters: Evidence from New Shocks Data. Okay, so let's start with a really basic question. When a central bank, like the Fed here in the US, raises interest rates, it's trying to cool things down. It gets more expensive for you to get a loan, for businesses to expand, so people and companies spend less, and the economy should, slow down. That's Econ 101. But what if I told you that for years and years, our best models showed something totally different?
And this is where things get really weird. On the one hand, you've got economic theory. It's crystal clear. Fed raises rates, economic output should fall. But then economists would look at the data from recent decades using their standard trusted models, and they'd get the chart you see here. After a rate hike, economic output actually went up. This wasn't just some small statistical blip. It was a massive contradiction right at the heart of macroeconomics.
So this brings us to our first chapter, a baffling economic puzzle, or what some called the case of the perverse policy effect. Seriously, for years, it seemed like hitting the economic brakes was somehow making the car speed up. Let's dig into the evidence, because it's pretty wild.
So get this, researchers took a very well-respected model, the Cristiano, Eichenbaum, and Evans model, and pointed it at the period after 1988. And this is what they got. A policy designed to slow the economy down was followed by a clear, undeniable boom in economic output. It's the complete and total opposite of what's supposed to happen.
Now, you might be thinking, okay, maybe that one model was just buggy, but nope, it wasn't a one-off. They tried another highly respected method, this one from Bernanke and Mehoff, and same thing. It produced the exact same perplexing result. As you can see here, after a rate hike, both output and prices seemed to rise. The plot was definitely thickening. And it just keeps going. Even a third method, the narrative approach from Romer and Romer, which was actually designed to get around the flaws of the other models, it failed too. For the modern era, it also found that tightening monetary policy seemed to, what? Stimulate the economy. So at this point, you have to ask a pretty serious question.
What on earth was going on? Had monetary policy just stopped working the way everyone thought it did? Or, and this is the scary part, were the very tools economists were using to understand the world just fundamentally broken? This whole mystery needed a culprit.
And that brings us to the prime suspect in our economic whodunit, the Federal Reserve itself. But here's the twist. The problem wasn't that the Fed was doing its job badly. It turns out the problem was that it started doing its job too well.
So here's the simplest way to think about it. The problem was the Fed got smarter. See, back in the day, the Fed was mostly reactive. It would see inflation go up, and then it would raise interest rates. But by the late 1980s and onward, the Fed had become way more forward-looking. It started acting based on its forecasts of where the economy was going, not just where it had. This quote from the paper just nails it. The old models were, as they say, misspecified. Think about it. If the Fed's economists see signs that the economy is about to boom in, say, 6 months, and they raise rates today to head off that inflation, well, what do the old models see? They just see a rate hike followed by an economic boom. So they draw the wrong conclusion. They think the rate hike caused the boom. Cause and effect got completely tangled up. So, if your old tools are broken, you need to find a new one. The researchers needed a way to untangle the Fed's predictable, forward-looking moves from its real, unpredictable shocks. And they found a brilliant clue hiding in plain sight in the financial markets. They found their clue in something called Fed funds futures. Now, don't let the jargon scare you. Just think of these as the market's collective crystal ball. They're basically financial contracts where thousands of smart investors and traders are all placing bets on what the Fed's main interest rate is going to be in the future. So by looking at these contracts, we get the market's best guess of what the Fed is about to do. And this, right here, is the breakthrough moment. The researchers realized they could use these market bets to isolate the one thing that truly matters for understanding the Fed's impact: the element of pure, unadulterated surprise. This was the key that was going to crack the whole case. And their method is just beautifully simple. Step 1, you look at what the futures market is predicting for interest rates just moments before the Fed makes its big announcement. That's what's expected. Step 2, you watch what the Fed actually does. And step 3, the difference between what everyone expected and what actually happened,
That's the surprise. That's the true unpredictable monetary policy shock.
So this gives us a brand new, much cleaner definition. A true monetary policy shock isn't the rate hike itself. Nope, it's only the part of that rate hike that the market did not see coming. It's the genuine news, with all of that predictable, forward-looking stuff stripped away. The very stuff that was confusing all the old models.
And this is what it looks like. This jagged line here represents those surprises from 1988 to 2008. Every time it spikes up, that's a moment the Fed tightened rates more than the market expected. Every time it dips, they eased more than expected. This, the researchers argue, is a pure, clean signal of monetary policy's real, independent impact.
All right, so with our new, clean shock data in hand, it is time for the verdict. Did this new way of looking at things finally solve the great puzzle of the perverse policy effect?
This is the moment of truth. When you take this new surprise measure and plug it back into the economic models, does the world finally start to make sense again?
The answer is a resounding yes. It absolutely does. Look at this graph. This is the payoff. The mystery is solved. Using this new surprise-based data, a surprise rate hike does exactly what the textbooks always said it would. It causes a clear, significant, and lasting drop in economic output. The models were fixed. The world made sense again.
But, solving that puzzle wasn't the only thing this new method accomplished. Because in the process, the researchers stumbled onto a second discovery, an arguably even bigger one, a major twist in the tale. The researchers found something that honestly was even more surprising, and it all boils down to this one number, 50%. So what in the world could that possibly mean for our economy?
Well, it means that these little monetary policy surprises, these tiny unexpected nudges by the Fed, are incredibly powerful. So powerful that they might explain up to half of all the business cycle ups and downs, the volatility in the entire U.S. economy. That is a huge deal.
And this chart just illustrates the point perfectly. I mean, look at the difference. Before, using those old, confusing measures, economists figured monetary policy shocks explained maybe 20–25% of economic swings. But this new, cleaner measure suggests their impact is potentially double that. It tells us that monetary policy matters way, way more than we ever thought. So we're left with one final and really important question to think about. If the unexpected actions of central banks have such a massive impact on all of our economic lives, what does that tell us about how important their communication is? It suggests that maybe, just maybe, what a central bank says and how well it signals its future moves is just as important as what it actually does. Something to chew on the next time you see a headline about the Fed.